introduction. It's a pleasure to
Thank
be
you.
with you. I made a promise to the organizers that I would try to speak slowly, which is very difficult for me because I get very excited about these topics and I go really, really fast. So please jump in at any time, particularly to our translator friends if I'm going too quickly.
Will do.
Okay, thank you. So what I'd like to talk to you about this evening, I know many of you, you're deep into the program. You've heard from academics in the entrepreneur space. You've heard from entrepreneurs, venture capitalists. What I'd like to do, you heard in the introduction, my company, Cravety, we do work in the human capital space with technology. We are also a startup. And so what I would like to do is I have been asked to take you through the challenges and the learning and the lessons that we have gleaned from being so early in this process. And so I have done many successful pitches over the years. Every pitch is different, right? Every capital raise, which we have just started ourselves, is different. And so I think what they'd like me to cover with you today is many of you may be in a similar situation where you're just starting to raise money. So I'm going to be speaking to you as your peer. I'm going to be speaking to you as someone who is facing these similar challenges. And I'm going to tell you very briefly about our software as a service or SaaS-based product. I'm not going to spend too much time on that because I'd rather help you learn from what we have with this particular capital raise and what the market looks like right now. So with that, I'm going to share my screen and we will get started. Are you able to see my screen?
Yes, everything is perfect.
Okay, great. So perfect is a very high bar. I'm going to make sure this is just okay. So if it's better than that, you'll be very happy. Okay. So all kidding aside, so my name again is Edwin Bodensiek. I'm going to give you some early lessons from the front lines of pitching for technology entrepreneurs. So the challenge that we often face, right, is you have a vision for something you want to solve. And often, actually almost always, you're pre-revenue. You have not yet sold anything. You have a vision. This is where all of us started. And again, some of you may be more advanced in your stage, in your cycle than this. Some of you may be at the starting line. We are just past the starting line where we're raising money, as I'll explain to you here in a moment. The challenge then is selling this vision. You see some important dots to connect. You see a solution to a problem. And then the other challenge is accessing what we call angel funders. And you've heard this term many times, I'm sure, this past week or so. But accessing the angel funders, where do you find them? I'll share with you how we did so. And then the other challenge is, and this is, again, I'm speaking about my company. I think this may apply to many of you as well. Balancing the need for working capital before you've sold anything. You have the need for the capital. You want to balance that against diluting too much of your company. And so in my case, I started by myself. I then brought on 5 other full-time partners, each one of them with different skill sets that I knew that giving away part of the equity of my company, going from 100% owner to a smaller share to have a smaller share of a much bigger pie was much more preferable than being 100% of a smaller pie. Okay, and so at the same time, we don't want to dilute ourselves further, but that's going to be necessary because, of course, angel funders are going to want something. So how do you balance that need? I'll talk to you about that. One of the first things that we did was we said, how far can we take this with that term I know you've heard before, and that's bootstrapping. right? That is with the capital that and the savings that we can put into this ourselves. I put in the biggest share. I'm also the biggest owner of the company. And we had others donate their time and their resources. Some of them had cash to put in. Some of them had what we call in-kind work, right? Where they're putting in time and very specialized expertise. We combined these things to take our product as far as we could before we started to raise the money. That was just a decision that we made. Many of you are going to have your own journeys, but this worked for us. So we have 6 full-time partners now and a contracting team. And we have backgrounds ranging from marketing to data science to artificial intelligence, human resources, and marketing. This is important because we have a technology product that helps human resources, that helps big companies improve their recruiting of talent. There's what we call a war for good talent. COVID has not changed that war. However, most people now are staying at the companies a little bit longer, so there's not so much of a problem with retention as there was before COVID. We think that that's going to return as people look for opportunities. If you're very talented, you're always going to be on the lookout for the best opportunity. And of course, our customers want to hold on to their talent as much as possible. And so what we do is we combine behavior science, looking at what intrinsically motivates human beings. We combine that with mobile-based technology so that somebody who comes into the funnel, and when I say funnel, I'm talking about job candidates, you want to convert those job candidates into your new hires, your new talent. And so these very large enterprises spend a lot of money recruiting talent, often to lose them to competitors before they even get to the job interview or before they even accept a job offer if one is made. And then even worse, when they start the new positions, some of them have a bad experience in orientation and they end up leaving in the first year or even the first 90 days. And this is very painful and very costly. And so what we're able to do is we're able to give people a superior experience by plugging into these large information systems. They're called HRIS platforms and applicant tracking systems, or ATS. We plug into these existing systems. We do not have to replace them. We figured out a way to make you download this application. We plug into these systems so that you as a candidate at the top of the funnel, you know exactly where you are in the process at all times. If you submit the application, if the application is being reviewed, you can see that on your phone. You know exactly where things are. It's not like you apply for a job and it goes into some black hole and you wait and wait and wait and do not hear anything. We proactively send these notifications about where you are. We then use the behavior science to start to understand how engaged you are and clicking on different things. We send you videos about the company, get you excited about working for that company, and we're always moving you through the process. We have what's called a state engine. A state engine is the proprietary technology that we have that looks at the state that you are as a candidate. We're moving you through the process. As a new employee, moving you through that process, you know exactly what you need to do when. So for example, when you show up to your job interview, you can download a digital badge as one example of what you can do with our product so that you do not have to wait at security. You feel like they were expecting you, and it's a much better human experience to sail through security and to have even directions on your phone to where you're going. We've journey mapped that entire process from a human experience design perspective, so that you always, as a candidate, as a new employee, you always feel great about this company paying attention to you, personalizing the experience. You get excited, you're engaged, you're much, much less likely to drop out of the process because our customers are going to be very intentional about the experience you're getting through our product, which we call Pathways EX. EX stands for, you might have guessed it, employee experience. And while a translator catches up, I will have a quick drink of my coffee here. Okay, so before I tell you about the pitch then, and what we've learned, which I think will be most relevant to you, I want to tell you about our go-to-market strategy, because this affects how we think about our pitch to investors. Our go-to-market strategy, knowing that our product would have to be sold to very, very large customers, enterprises, 5, 10,000, 100,000, up to 1 million or more employees. That's our market, very large companies, enterprises. As a startup, it is very expensive, both in time and in resources, to go after those very, very big fish or whales, right? So our strategy became, let's partner with large companies to help them sell their products, and we'll use their platforms to come up with an integration so that they have an incentive to introduce us to their already large customers. So this is a channel partner strategy. We did this with 2 companies. One is called VMware in California. Another one is Dell Technologies in Texas. Both of them have access to very large enterprises. Both of them, within a month or 2 of understanding what we were trying to do, said, let's go after customers together. We found the right people to understand that potential, that synergy. And we are about to sign our first Fortune 50 customer with others hopefully on the way soon. That's important for the pitch because in our case, we're now decided, okay, we've taken this as far as we can. Having started this in January, the company started to develop the product in March of 2020. And so we've taken it, we can go a little bit farther, but we decided we are in a good position now to start to raise money, and we don't need all these funds to give away too much of the company too early. We're trying just to balance that very carefully. And so the product Pathways EX has been largely developed. This first contract we're going to get is very important to tell investors, listen, you can get in on this very early. Right now, we're about to sign a contract. The moment we do, which we expect to have happen in the next 45 days, the moment that happens, our financial outlook is going to change. Our valuation is going to change. And so this is why right now we're taking many, many meetings. I have another investor pitch later today. And then another one tomorrow, which I'll tell you about, in front of 200 or 300 investors. It's part of a venture fair online. I want you to look up, I'll give you the first tip. There's a company in India called Kiwi Technology. It's Kiwi technology. And so they put on these venture fairs. In this particular example, they are going to put us in front of nearly 300 investors, but guess what? We only get 4 minutes. So normally in a pitch, you're going to ask for 20 or 30 minutes for the first meeting. If you're lucky, you'll get an hour. And so you have the time to explain things, as we are doing here with you today. Tomorrow example, 4 minutes is very, very difficult. I can tell you, having done many, many successful pitches and raises over the years, I've never done one in 4 minutes. So that you to be prepared to be very flexible for these circumstances. However, you could see the advantage of us waiting as long as we did, because now we're able to say we're about to have our first customer. We don't have it signed just yet, so there's still a little bit of risk, but it's 90–95% likely. And so now investors are getting much more interested, and we can negotiate at least somewhat better terms in that capital raise. So here's what we're looking to do. We limited how much money we were raising on purpose. We do not, it's very expensive to raise too much money too early. You might have to do that for whatever reasons. You need the capital to get started. That's just what you do, and that's understandable. In our particular example, we were looking to raise just $1 million US. We've raised 250,000. Not all of it was cash. Some of it was, we got a credit from a programming team in exchange for some equity. We needed some additional help. We got another $50,000 in cash. And so again, we've just started this process. I think based on how far we are with this customer that I mentioned, that it's going to go very, very quickly. And again, it's because we waited. And the terms we're offering is what's called a convertible note. So this is very common in the US market, at least, which all of you can have access to, and thanks to the internet and your own connections. But the convertible note opportunity will allow us to say, you give us these funds, we give you a 24-month term. That's how long we have to pay it back, with 8% interest. However, if you choose to convert us repaying you into equity in the company, you can do that. And so that's important for investors who say, we think you're going to be very, very big. And so we would much rather have the equity in the company, or we're not so sure, we'll take our money back with 8% interest. It gives them options. And then we put, as an incentive, we give anyone who's signing up for this raise, this first round, which is really bridge financing for us to get to the first contract, 20% discount on the next priced round. So when we go after Series A, which will be more for institutional investors and not angel investors, we're going to ask for much more. However, it will be worth much, much more. So if at that point we're worth 10 or 20 million, or hopefully more with the additional contracts, each contract for us is between 2 and 3 million. These are very, very large enterprises. These sales cycles take a long time, 6 to 9 months. But they are very, very big when we get one. And so the other incentive we're offering angel investors just in the next 45 days is a sprint to complete this raise, is a cap of $5 million. And what that means is if we're worth way more than that, we will cap that valuation at 5 million so that what they give us now is protected, is worth it if they choose to convert into equity later. That's very, very appealing. We came up with these terms, consulting an expert in putting together very competitive financing terms, a company we use called Via Capital, and they helped us in another way, which I'm going to share with you on the next screen, which I think you'll really appreciate given the formal process they put us through. And the other thing when you're raising money is, of course, you're going to be asked, how do you expect to use these proceeds? In our example, we are very clear. You see these 4 bullet points. I know this is English, but just very quickly, on the right-hand side, what you see here is we're going to use the funds for additional product functionality for the Pathways EX solution. We are building this, completing the build as quickly as we can. We can go a lot faster with the capital, particularly to get ready for this first contract and the ones to come. We're also going to use the proceeds for additional services. We want to continue to develop the behavior science and talking to and consulting with organizational psychologists. And then the last 2 are very important for investors because we want to put more money and more support behind the partner channel development. We don't want to limit ourselves to just Dell and VMware. We can work with Microsoft. They have a competitive solution. We could also work with a big company called ServiceNow. We need support to develop those relationships. And of course, marketing. We have to tell the HR leadership of these big enterprises worldwide that this solution even exists, and that takes money. Okay, so I mentioned Via Capital. So this is important because when we put together this pitch, usually you will not get a formal report. Usually you're being evaluated on who knows what criteria. You can get a sense of it, of course, by research, having done this yourself. But by and large, you're being evaluated according to criteria that's largely unknown. Now, they're going to look for, obviously, they're going to look at the strength of your team. They're going to look at how much traction you have in the market. They want to look at your financial projections. Those things are true. the reason I'm sharing, the reason I'm about to share with you this investment readiness report is it's the first time that we had a formal evaluation done of our pitch. And I'm going to share with you the results of the first pitch we made very recently, because I shared with you, we just moved to this stage as a company. And so these early lessons I think are important because we got formal feedback, and they did it for us in 5 different categories. They are product, the strength of the market, the strength of our team, the traction we're getting, and our funding requirements. What that means is, are the terms that we offered competitive? Are we asking for too much in return for what they're getting in return? The investment readiness score that this firm offers, they rank you from 1 to 10. What we were told is, for the first pitch, it is very rare to have an overall score more than a 6. And so that we were very, very happy to hear that, because we looked pretty competitive. There was room for improvement. And so that's why I'm sharing this with you, because we're in the process of updating our pitch deck and our talk track to reflect what we heard. So please, I hope this helps you just as you think about refining your pitch, okay? Okay, so I told you the 5 categories. Let me give you some details. So on product, you can see here, I think we've had some questions come in. I'll take a look at that here shortly. Okay, so on the first category of product, so this is a tool that they used. This is the criteria they were actually using to evaluate us. And I would submit to you, whether they had these exact questions or not, that your investors that you are pitching to are at least going to be thinking about the following things. So product, how ready is your company's lead product or service for the market? We scored that one 6.3, above average. How well does the company's product solve a major market problem? How strong is your intellectual property protection? If somebody invests in this, is someone else going to cheat you out of it or beat you to the market by copying what you do? Are you protected? We scored very high there because we've been very aggressive about that as well, making sure that we are protected. Do we have an obvious and significant competitive advantage? And we scored just slightly below average, 5.7 on this. We know we have a competitive advantage, but we did not talk about this enough in our pitch, is what we're hearing here. And so we need to make sure we address that. Again, very grateful for this kind of feedback, 5.7. Some of the actual feedback in terms of the words that people used, they said the concept made sense. Investors said, we couldn't tell who else was operating in this space. There was no real mention of competition. And so this told us very clearly, we need to make sure we tell people what competition is out there. It's actually a good thing to have competition. It reassures investors that even if you have a competitive advantage, and you should have a differentiation or differentiator, that there are competitors operating at least in the space. So that, that's very, very reassuring. We also heard losing hourly employees is expensive. Your pitch needs more focus on what the product does and not so much on how it does it. Again, very helpful to hear that. The other thing we heard was on the second category, market. Our investment readiness report reveals that when investors are considering how large the addressable market is for our product, they like that very much. You can see this very high at 7.3. And no surprise, when we are considered for how competitive the market is for our product, we ranked very low because we didn't mention competition enough. So you see that very low score there, 3.3. Don't make that mistake. We're not going to again. How easy or difficult will it be for the company to reach customers? We ranked very high here, 7.7. And that's, of course, we think because of the partner channel strategy that I mentioned. Our go-to-market strategy is very, very clear. And the investors recognize that. Very reassuring for them. How realistic is our company's go-to-market plan and our chance of successful execution? This also ranked very high, and it should, because we spent a lot of time developing the market plan and also executing the product as far as we could take it with available resources. Some of the words they used around this was reassuring to us this time when they said, investors said things like, channel partners are key, otherwise your lead time and your post-sale integration will be just too long for the company to survive. If the product actually works to improve employee retention, your partners should have a field day with this, which means they will really, really be aggressive about taking it to market and selling. Another comment we had was your first customer is key. We did not entirely understand where VMware, Dell, and your company, Cravety, intersect. So we need to make sure we do a better job in telling that story of how the three of us are working together. One investor actually said, your partner angle is the only play here, they said. We disagree. We think we can also do direct sales ourselves. However, they are correct that the partner angle is the most significant play to market that we have. Okay, the third category. So far we've covered product feedback, market feedback, and now team. We have, we spent a lot of time at the beginning of our pitch describing our backgrounds. I have not done it for you today for sake of time, but we will do that on a pitch. We know from experience that investors, they want to feel really, really good about team dynamics, your ability to execute, and who you are, like what your experience is. So they ranked us on three things. How would you rate the experience level of the CEO of the company? This happens to be me, happy to see a 7.5. How would you rate the overall depth of the management team? 8.5. I love that we ranked this high. I'm reminded of the quote from Steve Jobs, who famously said, make sure you hire people that are smarter than you are. And I feel like I have done that. How would you rate the overall execution risk of the management team? 8.0 is also very high. We've attracted people as partners who have had successful exits, other people who have run much, much larger SaaS-based platforms, and that gives investors a lot of confidence. Some of the words they use for describing our team: it looks like a great team, it's largely complete. I would like to know more about the founders of the business. So they want to know even more background on us. Very interesting. We thought we were spending enough time on that. Really, this investor thinks they wanted to know even more. This, by the way, oftentimes with an investment pitch, and again, I'm sure many of you are at different stages and have gone through your first rounds or in the middle of this now, and you know this, but for those of you who have not, who are just starting to put together your investment pitch, you rarely are going to get a commitment to funding at the end of the first pitch. It typically takes many, many other meetings and follow-ups to go even deeper. They want to introduce you to their friends and their network, and they're going to start asking you for detailed financials before you get to terms. And so this feedback is helpful because that is something that we know we could spend even more time on that second or third follow-up, going into more background on who we are as a team. Okay, the fourth of the 5 categories is traction and funding requirements being the last one. So on traction, that simply means, do you have sales lined up? Have you made sales? Do you have them in the funnel? How significant is the traction? Is the market reacting to what you do? We scored a 5.8 on that. We thought we would score a little bit higher, given we have a first customer lined up. The report that I'm sharing with you now is from about a month ago. And so if I were to give it again today to that same group, I think we would score a little higher because we are now starting the contractual negotiations with this first customer. And a month ago, we were not. Finally, funding requirements. Does the company have a good handle on the amount of money you need in this round to meet the key business objectives and the reasons for raising the money in the first place? And again, we only scored a 5.7, which is close to average, but slightly below average on this. This tells us that even though we're telling investors, angel investors in our pitch, we are telling them the amount of money that we're looking for. We are telling them what we want to use the money for. They just want more detail. That's what it told us. And then the highest ranking here was this last question. You see the 9.0 on my screen. That is to this question. Does management of the company have a good handle or understanding on the valuation of the company at this stage? And are they willing to give up sufficient ownership to balance investor risk? So remember that screen that I showed you? I'll back up really quickly. When you saw the raise, this is why this part was so important, that we structured this very, very carefully. We put a cap or a ceiling on the valuation. We're not telling investors now, we're worth this much. We've resisted that right now. We know that after we get our first contract, which will be 2.7 million, the first contract, that in technology, you can expect a multiplier of 4 to 7 of your revenue. And so that will be our first year revenue. It's recurring revenue, which is very nice. The moment that happens, our valuation now can be very finite, very precise, and it's going to be a lot higher than the $5 million cap that you see here. The reason that this is so low is to make this very attractive to investors who are willing to take the risk, but also to acknowledge the risk that though we're starting contract negotiations and we are, as we say, in the chute, we are loaded for delivery for the contract, it has not been signed. The ink is not yet dry. We've just started that part of the sale with this very large enterprise. And so that is why that ranked so highly with a 9.0. Okay. And then some of the words they used for traction and funding requirements for these last two categories. They do acknowledge your first major customer is key. They use a lot of moving parts, they told us. You're subject to much larger multi-billion-dollar partners. That is true. That's by design. You're just getting ready to launch, so there's no real traction yet. This tells me it's an investor who wants to see several sales, right? At that point, it becomes much, much easier. We're also going to be asking for a lot more to grow to the next level. They say, sounds like the initial feedback is good though. Same person said that. So that's good to hear. And then on funding requirements, the dollar raise amount and the terms, the screen I just showed you is actually the screen we use in the pitch, that one slide I just showed you. They say the dollar raise amount and the terms seemed about right. And that's exactly what we wanted. So with that, I'm going to share with you the last slide, and that is what we're doing about it. And then I'd like to take your questions. So what we're doing as a result of this feedback is as follows. We are developing a new slide deck. Our target is no more than 15 slides. The presentation I'm doing tomorrow in 4 minutes, I've managed to get that down to 5 slides. But normally in a 20 to 30 minute presentation, 15 slides. And I was so happy with the feedback that we had that I'm reorganizing our pitch deck according to those 5 categories. In other words, if that's what they're evaluating us on anyway, let's meet them where they are. So the new deck will be simply team with additional background on the founders, market, product with more what and less how, and more of more competition listed, traction, and funding valuation. We also are, and I need to update this slide for you. We just finished this week an executive summary. And so this is something we're using to send in advance of the pitch so that when you're making those first calls or emails, outreach, and they ask you for your deck, sometimes you don't want to send it right away. Sometimes you want to send mass emails if you've developed a target list. A pitch is a very large file. It's also a lot to ask someone to look at without getting to know you. A one-pager or an executive summary can be very powerful. And so we've developed one for that purpose. And our other two action steps are we've started to develop in a program called HubSpot, a CRM database of all of our targets, and we are doing daily outreach. We have someone helping us to make sure that we send 10 to 15 emails very targeted to investors every day. And then finally, after the $1 million is raised, we think we're going to need about 12 months before we get to Series A, which would be much more buttoned up. We're going to have, at that point, trailing income to list and a much even more powerful story to tell. We're also going to be asking for a lot more. So with that, I'd like to take your questions and do a time check and have some more coffee.
Thank you so much, Ed. Thank you. Thank you for your presentation, and thank you for sharing the insights of your fundraising. It's extremely valuable for everybody. We have a lot of questions